Most small business owners have no idea what their business is worth until they decide they want to sell it. In my opinion, that's leaving it way too late. If you're not an accountant, valuing a business can feel like a total mystery, but it doesn't need to. In this video, I'll break down how to value a small business in simple, broad terms that don't require a finance degree. Whether you're looking to sell, to buy, or just understand your business's worth, I think you'll find this video helpful. Why business valuation matters. Knowing your business's value is crucial for making strategic decisions, securing investment, or preparing for a sale. Many business owners over or underestimate their business's worth, which can lead to missed opportunities or failed negotiations. A clear valuation helps you make informed decisions and plan for the future. There are 3 primary ways to value a small business, and you don't need to be an accountant to understand them. Just think of your business like an investment. So first, there's the asset-based method. This method takes everything the business owns, which are its assets, and subtracts everything it owes, which are its liabilities. The end result is the company's valuation. And this method works best for asset-rich businesses like manufacturing or real estate. Then there's the income approach. This approach focuses on a business's profitability or future earning potential. Typically, small businesses are valued based on a multiple of their annual profit. This method is widely used because it directly reflects how much a business generates. But just remember that you're usually going to need to normalize your company's profits before you calculate your valuation using this method. That means adding back any expenses that should typically be there, such as the cost of your time, and removing any expenses that are exceptional, like the cost of your company's 10th birthday celebrations. Then there's the market approach. This method compares your business to similar businesses that have sold recently. It's very simple, but it's not so easy to get hold of the data. If a similar sized business in your industry has sold for 3 times profit or 2 times revenue, then that gives you a guide as to what your business is worth. The best way to get hold of this data is to speak to brokers, other business owners, lawyers, and accountants in your industry, because they'll all have seen these transactions from the other side. It's important not to forget about cash flow. Profit might look good on paper, but cash flow is also very important to buyers. A business that generates steady, predictable cash flow is always going to be more valuable than one with erratic cash flow, even if they have the same profit. Buyers don't want surprises. They want businesses that will continue to make predictable revenue. Then there's the owner's role. If your business depends entirely on you, it's going to be harder to sell. A business that can operate without its owner is always going to be worth more. That means businesses with systems in place, processes, and other members of the team who can do most of the work are always going to be more valuable than businesses that are heavily dependent on the owner. Almost always. There are some exceptions to that rule. There are certain red flags that can significantly reduce the value of your business, so it's worth being aware of them. These are inconsistent revenue, excessive debt, which is always going to be a risk to the buyer, over-concentration on a single client. So if most of your revenue comes from one single client, then you're going to be more risky, because if that client walks away, the business loses a lot of value very quickly. And industry trends. So anything that's going on in your industry might make your business more appealing or less appealing at any given time. And there are also a number of non-financial factors that affect your valuation. For example, your brand, customer loyalty, intellectual property, or even your location. If you want a rough estimate of your business's value, use this formula. Normalized profit times industry multiple. For example, if your business makes £100,000 profit and the standard industry multiple is 3 times, then you're looking at a valuation of roughly £300,000. Of course, there are many factors that would play into this and could move your valuation up or down. If you're planning to sell in the next few years, here's what you can do to increase your valuation. Grow. Increase your profitability, strengthen your brand, diversify your revenue streams, and automate as much as you can. If you're serious about selling, it might be worth considering a professional valuation. Speak to your accountant, speak to M&A brokers or M&A advisors, and they should be able to help. But remember, there is no single source of truth when it comes to valuing a business. You will probably end up with a range, so it's worth checking multiple sources. I hope you found this video helpful. Please give it a like and hit the subscribe button for more content on SME growth, valuations, and exits. And if you'd like to talk about valuing your business or your own exit strategy, then please get in touch. My details are in the channel description.